Thank you for joining us for this week's podcast episode. There's one trade group that is making a little bit of noise about how government shutdowns impact federal mortgage lending programs, and each of you watching know that very well, as we went through over a month with no endorsements of home equity conversion mortgages or HECMs, and also we had no data to work with. So let's jump into this article from the Industry Trends, Mortgage Professional of America. The Community Home Lenders of America, or CHLA, welcomed the Senate's progress in ending the protracted government shutdown. And by the way, that was ended on last Wednesday. But they do want to address the persistent vulnerabilities in the federal mortgage programs that are exposed by that crisis, saying progress toward ending the federal government shutdown is welcome and should help normalize the operations of various federal mortgage programs, said Scott Olson, executive director for the CHLA. At the same time, he added, this will likely not be the last government shutdown, so they're calling on Congress and federal agencies to work together to correct budgetary anomalies that have essentially shuttered execution of certain new loans during shutdowns, such as rural housing service mortgage loans and the FHA reverse mortgage or home equity conversion mortgage, even as other programs such as FHA and forward loans are generally not affected, being deemed as essential. Now, how a traditional FHA loan can be deemed essential, but a reverse mortgage cannot, that's beyond my understanding. The trade group notes the impact on both housing and the overall economy and has ripple effects that go far beyond what you would expect. Federal employees miss paychecks and delays mounted at airports and other government services. And lawmakers on both sides acknowledge the truly precarious situation for workers in the broader economy. But the CHLA does note that industry and trade groups have noted that recurring shutdowns do undermine confidence in government-backed lending and also disrupt access to affordable housing, issues that do remain unresolved despite the imminent reopening. And that, again, was reopened last week, so hopefully we'll have very few flight delays on the Thanksgiving holiday. Today we're going to look at a recent Business Insider column that notes a very interesting retirement trend is beginning to develop, and that is the naturally occurring retirement community, or NOCR. So let's dive in. Better than Boca, communities where aging boomers can have the perfect retirement. It opens noting that to most New Yorkers, Coney Island is the people's playground, known for its treacherous cyclone rides and Nathan hot dog eating competitions. But to Ruth Douglas, it's been home to her for over 40 years. And by the way, if you've never been to Coney Island, I would strongly recommend that you do so. Lots of colorful people and activities in Coney Island, and be sure to get a hot dog. But nevertheless, she's widowed. She's 82 and lives alone, but unlike so many aging Americans, she doesn't feel isolated. In fact, several times a week, she goes to a local outpost where she takes dance and yoga classes that's put on by a nonprofit Jewish association serving the aging, JASA. She is also learning how to crochet and joins excursions to museums such as the Met, and she does that with her neighbors. So Mrs. Douglas is living her ideal retirement life. So why is that possible in an NOCR, or a naturally occurring retirement community? What's interesting is that these communities are not by design, they're organic. They happen to occur where there is a high concentration of older residents. And that being the case, it tends to attract even more older residents. Now, when you do have a designated naturally occurring retirement community, you typically have a nonprofit involved that offers case management, healthcare services such as mental health, counseling, and nursing care, and even social events. And Coney Island is one of the 43 such of these communities subsidized by the state of New York that is spending about $220,000 a year on average supporting each of those communities. Of course, reverse mortgage professionals know that most older adults wish to age in place and not have to move in retirement. So NORCs, or naturally occurring retirement communities, have been creating a kind of supportive, active community for decades. In fact, the first organized chapter was created in 1986 in the Chelsea neighborhood of Manhattan in a cluster of 10 buildings called the Penn South Houses. New York State began to recognize and funding a handful of these particular groups in the 90s. And in the early 2000s, Congress allocated some federal funding for select NORCs. These days, about 24 states have NORC programs. Here are the guidelines to qualify as an NORC in the state of New York. It must have a critical mass of residents over the age of 60, with 20% of the population in a rural area, or 30% of a suburban or urban neighborhood, or 40% in a building. It also needs a nonprofit sponsoring agency and another source of funding. But not all of these groups are recognized by the state, and not all are recognized to get the funding. But here is where these NORCs truly shine, and it's in the economic sense. Senior living communities, they have entry fees, and the median cost of assisted living is about $5,900 a month, while a home health aide is almost $6,500 a month. And a typical private room in an American nursing home will set one back about $10,600 a month. So that's a lot of change. It's really difficult, of course, for seniors to afford that. But this is where these communities can really help. You'll be shocked at just how inexpensive they truly are. It says that NORCs are a lower cost solution for people who cannot afford other kinds of independent or assisted living. In New York, they cost the state about $500 a person a year. And because NORCs often keep low-income New Yorkers out of nursing homes, which are covered by Medicaid, they can save significant sums of taxpayer dollars. Financially, it's a no-brainer for the government to invest in them. Now, in the case of Mrs. Douglas, all of her services are actually subsidized, which is a blessing for her. They're being paid for by the state. And NORCs that are not state-funded tend to charge a nominal fee for their services. NORCs do not have the medical care that many older or elderly residents would require, but for those that are ambulatory and in fairly good health who want to remain connected in their community, this may be the best option and also the least expensive one. The ongoing battle between the home equity investment company HomeTap and the state of Massachusetts may hold even larger implications for the home equity investment industry at large. HousingWire reports that new court filings reveal more details in the dispute over home equity investment regulations in the state, reports HousingWire's Neil Pearson. A lawsuit filed earlier in the year by the state of Massachusetts against the home equity investment provider HomeTap is now being allowed to proceed after a ruling last August by Suffolk County Superior Court judge. And the parties did make new filings following that ruling and also last week as they're attempting to convince the court of the merits of their argument. Massachusetts Attorney General Andrea Joy Campbell sued HomeTap in February of 2025, and they labeled the company's primary product offerings as illegal reverse mortgages that fail to comply with the state consumer protection laws. Presently, HomeTap is operating in 16 states, including D.C., and they believe that the integrity of the products and the financial flexibility they give is important for homeowners. But this lawsuit's going to continue to play out, and Massachusetts is now no longer listed as one of the states in which the company does business. Probably a wise choice for the time being. If this sounds familiar, there is a good reason. Of course, we had another case with Unison in the state of Washington, which said that they are, in fact, a reverse mortgage and will be regulated as such. In one filing, HomeTap argues that the state's actions are an about-face, a 180, claiming that neither the Attorney General's office nor the Massachusetts Division of Banks expressed concerns about the company's home equity investment product going back to 2018 when they were first introduced to the state of Massachusetts. The company also adds that the state bank regulator acknowledged that home equity investment products differ in many aspects from mortgage loans. They also note there were actually companion bills in the Massachusetts State House and Senate that were seeking to place home equity investments under the Department of Banks' purview. And that would specify that they are not loans and set forth obligations to ensure they're not deceptive or unfair. HomeTap does note that the timing of the suit from the Attorney General's office is also peculiar, as it comes 1 month after the State House and Senate had those bills to regulate home equity investments. As this case and perhaps others in the future do unfold, one thing is clear: the states do want clearer definitions of what a home equity investment is and more regulatory oversight. Now, keep this in mind. This is giving us a real close look about how regulators are thinking about alternative equity access models, and perhaps they'll smile a little bit more around the government's FHA-insured home equity conversion mortgage. We can only hope these states still love to make duplicative regulations, but hey, we've all known that for many years. But we'll keep track of these developments when it comes to home equity investment companies and any future lawsuits or litigation.